Hello champs! Hope you all are doing amazing. So in this video, let's revise Unit 4 of your Chapter 11 Company Accounts, that is Accounting for Bonus and Right Issue. From the exam point of view, this is a small unit but definitely has the potential to be asked for a good marks as a question, guys. So in the recent attempts, we have also seen questions being tested from this unit combining with other concepts as well. So let's give our best in understanding this with concepts, and then a good set of questions are also there for your practice. So let's begin. So first of all, to understand what is this bonus shares. So bonus in simple words is nothing but something additional we get in reward as return. So with respect to shares, we are going to understand how the issue of bonus shares been to be taken care, also its importance provided as per Companies Act. So first, an issue of shares at no cost to the current shareholders in a company, because it is nothing but a bonus share. There will be no cost involved either from a shareholder point of view to subscribe for these shares in order to get them for their total shareholding. This is based upon the number of shares that the shareholder already own, because every company decides something called as bonus proportion or bonus ratio. Now that is being allotted based on how many shares the shareholders are already holding for. So that is how the bonus shares will be calculated. Bonus issue, this is one of the important point, is also known as capitalization of profits. Now why it is capital called as capitalization of profits? Because it refers to process of converting profits or reserves into paid up capital. This phrase you will understand while we actually look at the accounting or journal entries, why it is called as capitalization of profits. If I have to just give you as a small summary now, because the issue of bonus shares happens through some free reserves, and there are some other reserves which can be considered for the purpose of issue of bonus shares depending upon the conditions and the mode for which the bonus shares are issued. We will look at that in some point of time. So what we do there is we convert the reserves into share capital. That's why it is considered as capitalization of profits, because ultimately what goes in reserves is nothing but part of profits. So that is why this is analyzed as capitalization of profits. More we will understand in detail by observing the journal entries. Further, what is the relevance as per Companies Act 2013? This issue of bonus shares is regulated by Section 63 of Companies Act. As per subsection 1, a company may issue. There is a provision which is given who or which are the companies eligible to issue bonus shares. A company may issue, that means it is an option to the company, fully paid up bonus shares to its members in any manner whatsoever out of free reserves, securities premium account, and there is a separate account called as capital redemption reserve account. So company has an option to issue fully paid up bonus shares. This is what is important for you to observe. First of all, if a company wants to issue bonus shares, the main point to consider or the main criteria here is the shares, whatever is being held by the shareholder, should be fully paid up. Then only he or she becomes eligible to bonus shares. So that is why the company emphasize the provisions is emphasized here is it may issue fully paid up bonus shares out of what? Free reserves, securities premium account, and then capital redemption reserve account. Bonus shares can't be issued out of reserves created by revaluation of assets. Another important point to focus. So bonus shares is nothing but converting my reserve structure into capital. Revaluation reserve. This is talking about revaluation reserve. If you remember, we had understood this in detail in the chapter depreciation and amortization. So revaluation reserve is created with the movement of asset value, that is either increase or decrease depending upon the scenario how we have treated it before. So that is created for a purpose arising due to change in the market value of assets. So that will not be considered as a free reserve available for issue of bonus shares. So that's why there is a clear restriction provided. Next, as per subsection 2 of section 63, bonus shares cannot be issued unless partly paid up shares are made fully paid up. That's what we understood in the first line here. A company may issue fully paid up bonus shares. So your first point to consider the issue of bonus shares is whatever the existing shares are already there, it should be fully paid up. So they cannot issue or they cannot proceed with the objective of bonus issue unless all the shares which are present are fully paid up. So partly paid up is not at all entertained. Next, section 63 subsection 3 prescribes that bonus shares shall not be issued in lieu of dividend. Some companies will think about, anyway they have to provide share of dividend to shareholders for the investment they make. So again, it purely depends on the judgment made by the company. So bonus shares, if they are proposing to issue, this is not considered as in respect of dividend. So that is what in lieu of dividend means. Dividend is completely a separate activity where it should be provided in cash, whereas this is approaching for shares. Further, issue of bonus shares can be seen in following cases. We just first understood what are the provisions as per Companies Act. So, by going through the provisions, we understood one important point that whatever the existing shareholders are there, first it should be fully paid up. So, then only the company can go ahead with the option of issuing bonus shares. But there are two areas where the bonus shares can be considered. The issue of bonus shares can be seen in following cases. First, issue of fully paid bonus shares. That is, the shares, whatever was existing is fully paid up, and then we are also issuing fully paid bonus shares. Second case is conversion of partly paid into fully paid shares. Now, what does this mean? Conversion of partly paid into fully paid shares. See, in the unit of issue of shares, we understood that shares can be issued in lump sum or in installments. Now, the point which we are going to address is if the shares are issued in installments. So, if it is issued in installment, we understand that there is application, allotment, and then further calls. So, in this case, what happens? Assume the company has two calls, first call and then second and final call. So first, until first call, the money is called up and is also received by the company. Last call is pending. The company decides that instead of I calling and receiving it from the shareholders, I can stop the amount calling here itself, and whatever was the balance as the final call will be considered as a part of bonus issue, because ultimately bonus concept is nothing but giving without any additional cost. So if I collect money, it is as good as I'm collecting price for it. So if the company decides instead of calling for the next installment, we will compensate this with issue of bonus shares. There is this arrangement also available. I hope these points are clear. You will get more clarity while we look at the accounting entries. Done. Further, conditions for issue of fully paid bonus shares. See, fully issue of fully paid bonus shares is having some prerequisites which need to be complied. This is regulated as per Companies Act. What are those points? Let's understand. First, it should be authorized by its articles. What should be authorized by articles? First of all, issue of bonus shares. And then subsequent point is it should be fully paid up. It should be mentioned in the articles of the company. Next, it should be authorized in the general meeting of the company. Whenever the company decides to come up with bonus issue, they should make sure that it has been discussed, that it has been approved by the remaining members sitting in the annual general meeting. Next, company has not defaulted in payment of interest or principal of fixed deposits or debt securities issued by it. When the company is going for bonus issue, the company should make sure that it has not defaulted with respect to any interest payment or any installment repayment when they have borrowed some debts, that is debentures or securities. And one more point is with respect to fixed deposits. So if the company has not defaulted anything, then they will be eligible with respect to issue of fully paid bonus shares. Next point, the company has not defaulted for payment of statutory dues. Statutory dues means dues which arise due to some particular loss of the employees. Examples could be contribution to provident fund, gratuity. Provident fund and gratuity are some exclusive acts applicable for employment. You have certain restrictions or rules provided there as well. What is this point with respect to bonus issue is company should not have defaulted. for payment of statutory dues of the employees, because statutory dues is nothing but complying with the due dates. There is a contribution which goes as employer from the company side, so they are just pointing out on that aspect here. Last case, partly paid up shares if any outstanding on the date of allotment are made fully paid up. See, because the prerequisite of issue of bonus shares is nothing but the shares should be first of all fully paid up. So if there is any partly paid shares, you first make sure it is fully paid up as on the date of allotment and then proceed with issue of bonus shares. I hope this is clear. Next, securities premium account and capital redemption reserve cannot be applied towards payment of unpaid amount on any shares held by existing shareholders. So there is a clear restriction. What it says is there is a two specific reserve, that is securities premium account and then capital redemption reserve, which you cannot use for converting partly paid into fully paid. Is nothing but this case what we discussed, wherein the company does not expect the final call money. Instead of that, they will convert it into issue of bonus shares. For this purpose, these two reserves cannot be utilized. I hope this is clear. After understanding, we are just now going forward to know the journal entries. We understood issue of bonus shares can be observed in two scenarios. So that is where I have written issue of fully paid bonus shares and then conversion of partly paid into fully paid shares. We will understand the entries one by one. Issue of fully paid bonus shares. See, first of all, we are converting whatever reserves into share capital. So the first point to understand is what reserves are eligible to go ahead with this activity. So there are specific reserves. What are those reserves? First one is capital redemption reserve. Whatever we are going to understand, you will utilize the reserves balance for issue in the same order what is written here, guys. Be very specific. So first priority will be for capital redemption reserve. Likewise, if there is any capital reserve balance, remember while the forfeiture of share happens, there is an amount which goes to capital reserve. Likewise, if the company is maintaining any previous capital reserve balances, that will also become eligible. So, second priority will be with respect to your capital reserve. Then there is securities premium account. Then there is general reserve and profit and loss. These two are exclusively called as free reserves. Free reserves. There are specific points which needs to be taken care here. So first, capital redemption reserve, first priority. Second priority is capital reserve. Third case, securities premium account. So here there is a specific scenario. We will understand that whether the issue of bonus shares is proposed by a listed company or other than listed company. Now, what does it matter, ma'am? So there is a specific point provided if we are utilizing securities premium account balance as a listed company. The specification mentioned here is you can only utilize those amount collected in cash. That means whatever is sitting in the securities premium account, there is a partial amount collected in cash and other than cash. So for the purpose of bonus issue, if it is done by a listed company, so we will only or we can only utilize those which is collected in cash. This is a specific point. Now, what is a listed company? Those companies which are listed on the recognized stock exchange. Other than listed company, there is no such restriction. Whatever is securities premium account balance, we can entirely utilize. Clear? After providing from all of these reserves, if there is still excess amount required, we'll make use of free reserves. What includes in free reserve? Your general reserve balance, profit and loss account balance. Free reserves means these reserves has no specification that it should be used for a particular purpose. That's why it is considered as free reserves. So this is the utilization of reserves. You will debit. Two, bonus to shareholders. Like you observe, we always first understand the due entry. What are we doing here? Here also we are making due entry. So we made use of all the reserves. Please be very careful as I'm repeating it again and again. You should use in the same order what has been mentioned here. What is the order? First is capital redemption reserve, then it is capital reserve, securities premium account, then general reserve or profit and loss. That is free reserves after securities premium. So here we will first make it due. All these debit to bonus to shareholders because that is what I am proposing. Next, when I'm giving bonus to shareholders, it is nothing but converting my reserves into capital. So ultimately, your capital balance should be credited. So what will be the next entry when the bonus is issued? Bonus to shareholders account debit to share capital. So this is what is being now cancelled when the shares are getting issued. Understand one important thing here. Bonus shares is available only to equity shareholders. Preference shareholders do not get an option to have the bonus issue because it is very logical. Preference shares are maximum repayable at least up to 20 years. So there is no point of providing bonus to them again. I hope the entries are clear. These are the two simple entries what you have to observe, guys. That is first utilizing reserves and making it due. So what all reserves you take debit to bonus to shareholders. Then when the issue is happening, bonus to shareholders account debit to share capital. I hope this is clear. Next, conversion of partly paid into fully paid shares. What is this category? Remember, I told the company is not taking in return the ultimate call money. Instead of that, they will convert this into bonus issue. That is, this part is given as a discount, which is as good as issuing bonus shares. Now, how this is done? First point is same. I will utilize reserves. Same is only with respect to the approach. But there is a point to be considered with respect to what reserves I can utilize. If you remember, there were few other points which we discussed. There is a clear restriction. Securities premium and capital reserve, redemption reserve cannot be applied towards payment of unpaid amount. This is nothing but paying unpaid amount. So those two reserves will be completely eliminated. That point should be clear to all of us. So what would be remaining? Capital redemption reserve gone. Capital reserve also on the same note gone. Securities premium gone. So the remaining left out is nothing but our free reserves. So if it is a case that you are converting partly paid into fully paid, this is the entry what we observe. General reserve account debit, P&L account debit to bonus to shareholders. Due entry. Upon the sanction of bonus by converting partly paid into fully paid. Observe the next entry. See, this is done by because the final call money was supposed to be received. So what I do now, first I will make it due. What is the due entry? Share final call account debit to share capital. I hope this is comfortable, understood to all of you why this is done. Next, I will issue the shares. So what is the entry for that? Bonus to shareholders account debit to share final call. Observe carefully. Here I have already credited the share capital. Again, I will not bring it. So this is given for what? Because bonus is connected in order to not receive the final installments. So the last entry is bonus to shareholders to share final call account. I hope this point is clear to each one of you. Next, if the bonus issue results in increase of share capital beyond authorized capital, if you remember in issue of shares, we understood the meaning of authorized capital. It is nothing but the maximum capital. What happens sometimes is you are issuing bonus shares. It is nothing but additional shares. Because of this issue, assume it goes beyond your authorized capital, that is maximum capital. So you anyway fixed this could be the maximum capital. Now this balance is being exceeded. What happens now? First, the capital clause need to be altered by increasing share capital. In order to alter the capital clause, we will have to pass a resolution where in the annual general meeting of the company. This point is a law based point. If this situation appears to you in the question, you should make sure this point is being provided or mentioned. I hope this is clear. What does this point talk about? If due to issue of bonus shares, my capital requirement, which was fixed as maximum capital, increases. So at that point of time, we have to alter capital clause. How it is done? It is done by passing a resolution in the general meeting of the company. I hope this is clear. Now this completes your bonus issue concept. I hope it was simpler, just two arrangements and the entries you're supposed to know. Next topic, a smaller one covered here is rights issue. Now, what does right issue mean? So, understand a company requires more capital. So, if the company requires more capital, what should it do? It should raise additional capital from the public. So, what company does is instead of approaching first to the outsider, the company makes an offer to the existing shareholders itself. These are called as right shares, wherein the existing shareholders get that right to subscribe or get that first hand advantage before it goes to the public. And moreover, a plus point to this is you will get at a price lesser than the current market price, or what is the price the company is going to decide on to issue in the open market. So this arrangement is called as right shares. What to be understood, what is connected with respect to its issue, let's understand. The existing shareholders have a right to subscribe to any fresh issue of shares by the company in proportion to their existing holding of shares. If you understand, both for bonus as well as for right, we have one simple requirement that there should be existing shareholders in a company. They have an implicit right to renounce this in favor of anyone else or even reject it completely. See, when the right shares are offered to the shareholders, they will have three options. First one will be to accept, that is, accept the offer and buy the right shares. Second one would be to renounce the right. What does renunciation means is the company has given that right to the shareholder. Shareholder is not able to subscribe. So what the shareholder can do is he can pass on this right to any outsider. Now this right is available to that outsider because a current existing shareholders has associated this. So this is called renunciation of right, just a passing of right. So shareholder has this as a second option. Third option is reject the offer. That is, whatever is offer made to subscribe for right shares, outright rejection. These are the three cases. In other words, the existing shareholders have right of first refusal. That is, the existing shareholders enjoy a right to either subscribe, that is, accept, or sell their rights or reject the offer. There's three situations. Next, exceptions to the rights of existing shareholders. Whatever points we understood, that is how a right share arrangement to be considered. There are few exceptions. The shares can be offered without being offered for existing shareholders, because if it is a right share, that is the first point to foresee, provided the company has passed which resolution? Special resolution. So company has passed a special resolution. Section 62, which gives us the regulatory points for right shares, recognizes four such situations. What are this point which we are going to understand is this is an exception to the right shares. That means there is no requirement that there is existing shareholders. Apart from that, also they can issue shares. What are those situations? First one, employees under a scheme of ESOP. ESOP means employee stock option plan. If any shares are provided to the company's employees as a plan regulated from employee stock option, that is not considered as a right share. Second, when companies borrow money through debentures or loan and give their creditor an option to buy equity shares of a company. When the company has borrowed loan or debentures, instead of repaying it back, the company gives them an option to convert it into shares. That is the second case. Third, any persons, either for cash or for consideration other than cash, if the price of such shares is determined by registered valuer. Remember, we understood a scenario where the shares can be issued for cash or for consideration other than cash. So, if the price is determined by the valuer, that is also considered here. Next, when loan has been obtained from the government and the government in public interest directs the debentures or loan to be converted into equity shares. See, these 2 points are very much similar. In the second point, what we saw is you are borrowed from an outsider or any debenture holder. In the fourth case, you have borrowed it from government or any government entities, and on the order or direction of government, you are supposed to convert the loan or debentures into shares. So these are four exceptions what we can observe. So what are the calculations you come across in right shares? First is to understand book value of a share. How do we arrive this? This is net worth as per books divided by number of shares. Net worth is nothing but your total of assets minus outside liabilities. So market value may differ from the book value of shares. What did we calculate here? Book value. There is another value called market value. Next, market price. The market price which exists before the right issue is termed as come right market price of the share. See, these are the points which we are going to figure out in this right issue. Come right market price and X right market price. See, the element of right, that is right issue, will definitely have an impact on the market price of shares. So there will be two extremes which you can see, that is come right market price, which means market price before right issue, and then there is X right market price, which is market price after further issue of shares. Right issue is termed as X right price of the shares. I hope these two wordings are familiar now. Next, right of renunciation is nothing but right of passing out. What does it mean? Right of renunciation refers to the right of the shareholder to surrender his right to buy the securities and transfer such right to any other person. So here there is no condition that he should also be another shareholder of the company. So it can be transferred to any other person. The renunciation of the right is valuable and can be monetized by the existing shareholders in well-functioning capital market. So whatever right you're passing is definitely having a value, that is called as value of a right. So here what they can say is they can monetize it and it can be well functioned in the capital market. The monetized value available to the existing shareholders due to right issues known as value of right. If a shareholder decides to renounce, that is pass on all or any of the right shares in favor of his nominee, the value of right is restricted to sale price of the renouncement in favor of the nominee. So this is talking about if the shareholder is passing on this right to his nominee. So then the value of right will be restricted to sale price of the renouncement of a right. That's it. If not, you can consider the real market value here. Further, how do we calculate value of right? It is simple because there will be two extremes what I mentioned. One, market price before right issue, one more market price after right issue. So this we can analyze as come right value of share minus X right value of share. That is market price before minus market price after will give me the value of a right. Don't you think this is very logical? Because there is a value for a right. How can you understand? Because of the difference between these two extreme prices. Next, sometimes the questions may ask you to calculate X right value of the share. That is nothing but market price of the share after right issue. How do we find that out? Come right value of existing shares, that is market price before right issue, multiply it with existing shares. How do we write this is come right price into existing number of shares plus right share into right issue price. So what would be the price they decide for the purpose of right issue? We will take this 2 on numerator. Divide this by number of shares totally available. That is whatever was existing plus whatever shares are coming towards right issue. So existing number of shares plus number of right shares. So what does X right value here mean? Take the market price before right issue into number of existing shares. This is to find out what is the value of shares before right issue plus right shares into right issue price divided by number of existing shares plus right shares. I hope this is clear to all of us. Further, what is the journal entry? What we understand for right issue? Normal entry, bank account debit to equity share capital if the issue of right shares is at par. If it is at premium, bank account debit to equity share capital to securities premium. The concept is simple because we cannot issue shares at discount. So you'll only have two possibilities, either at par or at premium. I hope the concepts are still clear. Moving on to questions. Following items appear in the trial balance of Bharat Limited. It is a listed company. These points becomes very crucial for our judgments to whatever concepts we have discussed as on 31st March 2022. There are 40,000 equity shares of 10 each. Capital redemption reserve, securities premium. This is collected in cash. Remember, it is a listed company. So if it is a listed company, I can utilize the balance in securities premium only if it is collected in cash. So that is clearly specified. General reserve and then surplus, that is credit balance of profit and loss account. The company decided to issue equity shareholders bonus share at the rate of 1 share for every 4 shares held, and for this purpose it is decided that there should be minimum reduction in free reserves. Pass necessary journal entries. So what is the bonus ratio? Bonus ratio is 1 share for every 4 shares held. That means how much is your total shareholding now? It is 40,000 equity shares. How do we calculate this? Let's do it as a working note. Number of bonus shares. So before this, I can write this down. What is the bonus ratio? Bonus ratio is 1 is to 4. So number of bonus shares is, what is my existing shares? 40,000 shares. Simple calculation, guys. They are telling I get 1 share for every 4 shares held. How many shares I am actually holding? 40,000. So I want what is the bonus share if I'm holding 40,000 shares. So how will I find this out? 40,000 into 1 by 4. So 40,000 into 1 by 4 will be 10,000 shares. Multiplying this with the face value will give me the bonus shares capital. So 10,000 into 10 rupees. So requirement here is 1 lakh, because based on that only I will find out what should I take from the reserves. Yes or no? So first will be the due entry. Remember, this is a case of issuing fully paid bonus shares. 10 rupees each, we will assume it is fully paid up. So what would be the entry? First priority will be your capital redemption reserve. Capital redemption reserve account debit. Then there is no capital reserve. Then we have securities premium. Full is collected in cash. So we will make use of the same. Securities premium account debit. What was the capital redemption reserve balance? 55,000. Securities premium 30,000. Then we have general reserve. Requirement was 1 lakh. How did I get 1 lakh? 10,000 into 10. So in 1 lakh, I've already set aside for 55,000 and 30,000. Balance is 15,000, which is what is required. To what? Bonus to shareholders account. That is 1 lakh being bonus issue made in the proportion of 1 share for every 4 held. Every 4 share held. I hope this is clear. So what would be the next entry? Next entry will be issue of bonus shares. Bonus to shareholders account debit. To equity share capital account. This is 1 lakh and 1 lakh being bonus shares issued. Simple, easy enough to understand. See, for example, what points to focus here is if this was not given, collected in cash, is it feasible for you to assume? If you are assuming, make sure you're giving a note because the question is clearly mentioning this is a listed company. So these are the points to take care. Next question. Past journal entries in the following circumstances. First, A Limited with subscribed capital of 5 lakh consisting of 50,000 equity shares of 10 each. Called up capital is 7.5 per share. So what was the fully paid up value 10 share? Till now 7.50 is called up. A bonus of 1,25,000 declared out of general reserve to be applied in making the existing shares fully paid up. So first, to issue bonus shares, it is being declared, but before it is being issued, partly paid shares should be converted into fully paid up. So first we will have to observe that entry. So what is the entry? First, a bonus of 1,25,000 is declared out of general reserve. That means they can only utilize general reserve balance, that is any free reserve balance, in making the existing shares fully paid up. They are not mentioning what is the general reserve balance, only one amount. So that is taken directly to general reserve. So what will be the first entry? First, taking out the reserve balance and then making call due and then issue of shares. First case, general reserve account debit. If you also observe, how are we getting 1,25,000? So out of 10 rupees, 7.50 is paid. That means how much is balance? There is 10 minus 7.50 is 2.5 into 50,000 shares. This is nothing but 1,25,000. So general reserve account debit to bonus to shareholders account 1,25,000 being general reserve balance utilized for issue of bonus shares. What will be the next entry? Making call due. So equity share final call account debit to equity share capital account. How much? Again, 1,25,000. How am I getting this? 50,000 shares into 2.50 per share being final call money made due. That is 50,000 shares at rupees 2.50 per share. Is this clear? Next. What is the last entry for this? We are issuing shares. So, bonus to shareholders account debit to equity share final call. 1,25,000 being bonus shares issued. I hope this was clear. Next, limited company having fully paid up capital 50 lakh consisting of equity shares of 10 each had general reserve 9 lakh. It was resolved to capitalize 5 lakh out of general reserve by issuing 50,000 fully paid bonus shares of 10 each shareholder to get one such share for every 10 shares held by him in the company. See here, the company, the requirement itself is telling having fully paid up capital. So nothing is partly paid up. So directly issue of bonus shares. The company has decided to issue 5 lakh worth as bonus shares. That is by issuing 50,000 bonus shares. So what is the proportion given? Each shareholder to get 1 share for every 10 shares held. That means if they are holding 50,000 shares, each shareholder will get 5,000 shares. So what will be the entry for this? First, general reserve account debit. General reserve account debit to bonus to shareholders account. How much? 5 lakh and 5 lakh. Being general reserve balance utilized towards bonus issue. Next will be issue of bonus shares. Bonus to shareholders account debit to equity share capital. 5 lakh and 5 lakh being bonus shares issued worth 5 lakh in bonus ratio, that is 1 is to 5. 1 share for every 5 shares held. I hope both considerations of passing journal entries is clear. Such question has appeared in the exam, guys, already. As you are observing, the simple concepts is what has been applied to reflect the journal entries. Next, following notes pertain to the balance sheet of Solid Limited as of 31st March. They are giving you a complete set of balance sheet to observe what items are present. So authorized is mentioned 10,000 preference shares and 1 lakh equity shares. Issued and subscribed capital, there is 8,000 preference shares and 90,000 equity shares. Observe one important thing here. 10 rupees is the face value, but out of this only 8 is paid up. So if the company is proposing for bonus issue first, this should be converted into fully paid shares. Reserves and surplus balances are given general reserve, revaluation reserve. So I can use this. I cannot use this because we understood the clear restriction. Securities premium is collected in cash. Was this a listed company? Nothing mentioned. So we can easily use complete balance, and then we have profit and loss account. So there is no capital redemption reserve separately given. Then there is secured loan, 12% debentures. On 1st April, the company has made final call. Obviously, they have to do if they have to proceed with bonus shares. 2 each on 90,000 equity shares. If you observe, the total number of equity shares was 90,000. So 2 each. The call money was received by 20th April. Thereafter, the company decided to capitalize its reserves. What does this wording mean? It is nothing but issue of bonus shares at the rate of 1 share for every 4 shares held. Show necessary entries in the books of the company and prepare the extract of the balance sheet immediately after bonus issue, assuming that the company has passed an important line necessary resolution at a general body meeting for increasing the authorized capital. So this point also confirms that with bonus issue, there is an impact on authorized capital, which is your maximum capital. So let's first record the entries. They are asking you two things. One, first record the entries and then give the extract of balance sheet. So first, if you observe what all reserves can be utilized, this is conversion of partly paid shares into fully paid. So only free reserves are eligible. I hope this is clear. So first, let's make the call money due. 1st April 2022. Equity share final call account debit to equity share capital account. How much is this? 90,000 into 2. Being final call money on 90,000 shares at rupees 2 per share made due. Clear? Yes. So next the question is also telling the call money was received by 20th April. So 20th April 22, bank account debit to equity share final call account. 1,80,000, 1,80,000 being final call money received. Now what happened? The company which had partly paid shares is now made fully paid up. Now the company is eligible to issue fully paid bonus shares. What is the bonus ratio? 1 share for every 4 shares held. So first we will find out number of bonus shares. Bonus ratio is 1:4. Number of bonus shares, same like how we found out earlier. So totally there is 90,000 shares into 1/4. So this will be 22,500 shares. Face value is 10 rupees. Face value is 10 rupees. So requirement here is 2,25,000. So now this 2,25,000, what balances are available to utilize? So capital redemption reserve is not there. So next priority will be securities premium. Securities premium is 20,000 and then we have general reserve which is 1,60,000 and the balance will be taken from profit and loss account. I hope this is clear. So the company decided to capitalize its reserve, show entry. So that is what is the next entry. Securities premium account debit. Then we have general reserve account debit. Then profit and loss account debit to bonus to shareholders account. How much is the securities premium balance which is available? 20,000. Then we have general reserve 1,60,000. So this becomes totally 1,80,000. Requirement is 2,25,000. So balance I will take it from profit and loss account. 45,000. So this is 2,25,000. Utilization of securities premium and free reserves for bonus issue. Next, what will be the next entry? Issue of bonus shares. Bonus to shareholders account debit to equity share capital. This will be 2,25,000. 2,25,000. I hope this is clear. Being bonus shares issued in the ratio of 1 share for every 4 shares held. That is 1:4. Is this clear? Now this was recording of entries. The question is also asking us to give the extract of the balance sheet. So we'll make use of the same values. Authorized capital, observe one thing. 90,000 was the existing shares. How much was bonus number of shares? 22,500. So 90,000 plus 22,500 will be 1,12,500. But what is your authorized capital? It is just 1 lakh. That means it is gone beyond the authorized capital. There should be increase in authorized capital. So how much will you increase? Up to 1,12,500. To do this, the company has to pass a resolution at the general meeting. The question clearly mentions us the company has passed necessary resolution. So we can just provide by increasing the capital. So how will this appear in the balance sheet? So this will be your balance sheet as on. So this is equity and liabilities. Under that, we will have shareholder funds, which includes your capital and then reserves and surplus. So under this, we will have to write authorized capital. There is some amount of preference shares, 10,000, 12% preference shares. 12% preference shares at rupees 10 each. And then further we have 1 lakh, which is now increased to 1,12,500 at 10 each. Equity shares at rupees 10 each. So this will be 11,25,000. This will be total authorized capital. Then we have issued and subscribed capital. There is 8,000, 12% preference shares. At 10 each. This will be 80,000. Then we have 1,12,500 equity shares at rupees 10 each. $11,25,000. Then we will have reserves and surplus. There was general reserve 1,60,000. We will write this down in notes to accounts. General reserve 1,60,000 utilized for bonus issue. This is how we will present as notes. How much did we utilize out of general reserve? We have taken full 1,60,000. So balance will be nil. Next, there is revaluation reserve, which is not at all utilized. Securities premium account. Revaluation reserve is 35. Securities premium is 20,000. We have utilized this completely. Utilized for bonus issue 20,000. So nil. Then we have profit and loss account. Minus utilized for bonus issue. So profit and loss account is how much? Balance is 2,05,000. We have utilized 45,000. So there is a balance left out in profit and loss. 2,05,000 minus 45. This will be 1,60,000. So this we will reflect in the balance sheet. Revaluation reserve is 35. P&L account is 1,60,000. This is profit and loss account. Notes to accounts 2. And there was one long-term liability secured loan 12% debentures that will as it is appear 5 lakh. 12% debentures 5 lakh. Now this is the balance sheet which will be prepared for companies. So this was just an extract of balance sheet because you are not given the complete details of assets and if there are any other additional liabilities after bonus issue, how would this reflect is to understand with respect to this question. In this question, the question itself clearly mentions that the company has passed a resolution. If that line was not there, you will also have to give an additional note for increase of capital balance in the authorized capital because earlier it was 1 lakh, now it has been increased to 1,12,500. I hope this is clear. Next. Next, an important question. This was what I was mentioning as it has appeared in the previous exams. So what you can consider here is they are mixing the concept of bonus with other units concept as well. You will understand after we read the question. The following is the abstract of balance sheet API Limited as on 31st March 24. So issued and paid up capital given. As in when you read, you will have to observe the pointers which is relevant for you to solve the question. There is 90,000 equity shares of 10 each fully paid up. So this is again an important observation if they test on bonus issue. Further, there was a calls in arrears 10,000 equity shares of 2 each. That means for 90,000 there is no problem. 10,000 has a balance of 2 rupees. 40,000 equity shares of 10 each, rupees 4 cash paid up. So there are two categories of share, one for 90, another for 40. For 40 there is only 4 paid up. Further, capital reserve, it is realized in cash. Capital redemption reserve is given. Securities premium, general reserve and P&L is provided. On 1st April, the company makes final call at 6 each on 40,000 shares. 6 was pending, so they are calling it. The call money is received by 30th April. This is the same point as we discussed in the previous question. On 1st May, the board of directors decided, a very important observation, to forfeit the share on which final call of 2 each is due. That is what we saw. There was a calls in arrears of 2 each. They are forfeiting that. That is cancellation to reissue the forfeited share at 11 each as fully paid up. So they are further reissuing this at premium, that is 11. To issue fully paid bonus shares in the ratio of 1 fully paid bonus share for every 2 fully paid shares held. And to use minimum balance of P&L account. Pass necessary journal entries in the books on the basis of the above decisions. There is an order structure given. So we will have to pass the journal entries in the same manner because the relevance of the previous arrangement should also be considered on bonus issue. What are you trying to tell, ma'am? You will understand it in the question. First, we will pass the entry for this. Company makes final call. So first, on 1st April 24, equity share final call account debit to equity share capital account. How much will that be? 40,000 shares into 6 each. 2,40,000. Being final call money on 40,000 shares at rupees 6 each made due. Understood? Next, this call money was received by 30th April. So 30th April 24, what will be the entry? Bank account debit to equity share final call account. 2,40,000. Being final call money received. So this was the first arrangement wherein we called and we also received. Next, on 1st May, the board of the directors decided to forfeit the shares on which final call of 2 each is due. So what will be the share forfeiture entry? I hope you all remember it. On 1st May, equity share capital account debit to, the amount is already transferred to calls in arrears. So 2 calls in arrears account. Then we will have to equity share forfeiture account. So now it is very important to write down the entries. Calls in arrears value was 20,000 on 10,000 shares. Understand, it is not 90, only 10,000 shares has a problem. So 20,000. If the amount is transferred to calls in years, that means calls was attempted. They had made the call, but the payment was not received. Hence, it is reflecting as calls in arrears. That means if I have to cancel it in the share capital, the entire face value gets cancelled. So how much will that be? 1 lakh. How did I get 10,000 shares into 10 rupees? So what is the balance which goes to share forfeiture? It will be what amount is already received. So here if you observe, calls in arrears was 2 each. That means out of 10, 8 was already received. So 10,000 into 8, that will be 80,000. Being 10,000 shares forfeited for non-payment of call money. Clear with this? Yes. Next. So this was forfeiture entry. We have done with this. Next is to reissue. The forfeited share at 11 each has fully paid up. So there is no issue happening at discount. So the entry will be bank account debit, equity share capital account debit. Then we have what? Securities premium account. So 10,000 shares at 11 rupees will be 1,10,000. 10,000 for share capital will go at face value, that will be 1 lakh. So 10,000 is your securities premium balance. Being reissue of forfeited shares at rupees 11 each. Now, after we make the reissue, remember there is a balance reflected in share forfeiture. For the purpose of reissue, we did not utilize this at all. So entire thing will be transferred to which account? Capital reserve. So equity share forfeiture account debit to capital reserve account. How much was transferred? 80,000. Entire thing will be going to capital reserve. Being balance in share forfeiture transferred to capital reserve. Clear with this? Yes. So what did we do now? We pass the forfeiture and reissue entry. After this, there is a bonus given to issue fully paid bonus shares in the ratio of one fully paid bonus shares for every two fully paid shares held. That means the bonus ratio is 1:2. Now, the important point what you're supposed to consider is what is the total number of existing shares. Observe carefully. There is 90,000 equity shares. Yes. And then 10,000 shares was cancelled. Later, if you observe, those 10,000 shares was additionally reissued. Yes or no? So further, again, 40,000 shares is also there. So totally, if you observe, there is 1 lakh shares at 10 rupees and 40,000 shares at 10 rupees. I hope you all understood. See, already there is 90,000 shares. 10,000 was cancelled and again it was reissued. So 10,000 is again back. So 90 plus 10, 1 lakh shares plus 40,000 shares. So if I have to find out the requirement here, for 1 lakh 40 at 10 rupees. So bonus issue is 1:2. Let's find out the bonus shares. Bonus ratio 1:2. Number of bonus shares is 90,000 plus 10,000 plus 40,000 shares. This is 1,40,000 shares into 1/2. So this will be 70,000 shares. So requirement in monetary wise would be 70,000 into 10 rupees, 7 lakh. So total 7 lakh is required. Now we have to observe very carefully what here is. There are various reserve balances given. First priority is capital redemption reserve, 1,60,000. Coming to capital reserve, there is already an existing balance of 60. One important point what you have to consider is you have also transferred the share forfeiture amount to capital reserve. Don't you think this should also be taken to the bonus issue? Yes. So this is the important point. 80,000 will be considered to this 60 plus 80. Then securities premium. If you also again observe, there was already an existing balance 1 lakh. Through reissue, there was shares reissued at premium. So you have transferred some amount to securities premium as well, which will again increase by 10,000. So these two balances should also be considered. This is what is important in this question. Is this clear? So first, capital redemption reserve 1,60,000. Capital redemption reserve account debit. Then we have capital reserve account debit. I hope these points understood to all of you. So capital reserve will be 80,000 plus 60,000, 1,40,000. Then is securities premium account debit. So securities premium is 1 lakh plus 10,000. So 1,10,000. So till now, 160 plus 140 plus 1 lakh 10. We have used 4 lakh 10. Requirement is 7 lakh. So next we have general reserve 1 lakh 20. Then profit and loss account. So minus 7 lakh, I can utilize 1 lakh 70,000. Just to cross check, 160, 140, 110, 120 and 170. To bonus to shareholders account. This will be 7 lakh. I hope these points are clearly understood. Being various reserves utilized for bonus issue. Next will be issue of bonus shares. Bonus to shareholders account debit to equity share capital account. This is 7 lakh. Being bonus shares issued in the proportion of 1 share for every 2 shares held. I hope this point is clear. This was again an important question. They've also mentioned to use minimum balance. Anyway, we kept it at last and we have taken whatever was required. So this was an important question which was merge of forfeiture, reissue and then bonus concept. A good one to practice. Make sure you are properly doing this. Next. This covers a good set of questions of practice for your concept of bonus issue. Now we will observe some for right issue. A company offers new shares of 100 each at 25% premium to existing shareholders on 1 for 4 basis. Now what does this mean? One right share for every 4 shares held. The come right market price of a share is 150. What does come right market price means? The market price before right issue. What are you supposed to calculate? Value of a right and what should be the X right market price of a share? See, value of a right is nothing but come right minus X right. So first we will have to find out the X right market price. We want what? We want come right market price into number of existing shares. Understand one thing. They are not mentioning how much is the total number of existing shares, but they are given us the proportion in which the right shares would be assigned. So premium to existing shareholders on 1 share for every 4 basis. That means if they have 4 shares, they will get 1 right share. This is what is understood. So what I want now, come right price into existing shares. So that will be 4 into what is the come right price? 150. I hope this is clear. Plus, what is the right share? 1 share for every 4 held. So 1 into what is the right issue price? 125. Company offers new share of 100 each at 25% premium. So 100 plus 25%. Divide this by number of shares, 4 plus 1. I hope this is clear. So 4 into 150, 600 plus 125 divided by 5. So this will be 725 divided by 5. That is 145. So this is what X right market price of a share. Value of right. Value of a right is equal to come right price minus X right price. So come right price is 150, X right price is 145. So value of a right is 5 rupees. Clear with this? Yes. Next question. A limited company having share capital of 25,000 equity shares of 10 each decides to issue right share at the ratio of 1 for every 4 held at par value. So the issue is happening at par. Assuming all the shareholders accepted the right issue and all money was duly received, past journal entries in the books of the company. There was only one entry, so issue is at par. So first we will find out number of right shares. 25,000 shareholders, 1 for every 4 shares held. That means 1 by 4. This will be 6,250 shares. So what will be the journal entry? Bank account debit to equity share capital at 10 rupees. So 60 to 500. Simple? Yes. Being right shares issued in the proportion of 1 share for every 4 share held. Clear? Simpler one? Yes. Now last question, a very important question again. So this tests us the concept of right issue and then bonus along. How to do? Let's understand. Following points pertain to the balance sheet of Mars Company Limited as of 31st March. So there is authorized capital. It has both preference as well as equity. Issued and subscribed is given 50,000, 12% preference shares of 10 each, fully paid up. Preference, there will be no problem. 4 lakh equity shares of 10 each, 8 paid up. So this is all important observations which we will have to consider. 8 paid up. Then we have reserves and surplus, general reserve, capital redemption reserve, securities premium collected in cash, revaluation reserve, and then P&L account is given. So this will not be available for utilization. On 1st April, the company has made final call at rupees 2 each on 4 lakh equity shares. Because 8 was paid up, they will have to anyway convert it into fully paid up shares. The call money was received by 25th April. Thereafter, on 1st May, the company decided to capitalize its reserves by way of bonus at the rate of 1 share for every 4 held. It is decided that there should be minimum reduction in free reserves. On 1st June, the company issued right shares, that is after bonus issue, at the rate of 2 shares for every 5 shares held on that date at issue price of 12 per share. All the right shares were accepted and the money was duly received by 20th June. Show necessary journal entries in the books for bonus and right issue. So this becomes an ultimate question for you to practice after understanding the concepts in detail. So first let's record the call money, due and then receipt. You can just start it here. 1st April 22. Equity share final call account debit to equity share capital account. How much is the number of shares? It is 4 lakh shares at 2 each. Being final call money made due at on 4 lakh shares at rupees 2 each. On 4 lakh shares at rupees 2 per share. Next will be receiving that final call money. Have they given us the date? The call money was received by 25th April. So 25th April 22, bank account debit to equity share final call account. 8 lakh and 8 lakh. Being final call money received. Done. Next. After this, on 1st May, the company decided to capitalize by way of bonus at the rate of 1 share for every 4 shares held. So what is the number of shares? 4 lakh. We'll do it as a working note. Bonus ratio is 1 share for every 4 shares held. Number of bonus shares is 4 lakh into 1 by 4. So this will be 1 lakh shares. Requirement will be 1 lakh into 10. 10 lakh rupees is required for the purpose of bonus issue. Was 1 share for every 4 shares held. Now we will first make the bonus issue. 10 lakh is required. So first preference is capital redemption reserve 2 lakh 40,000. This is happening on 1st May. Capital redemption reserve account debit 1 lakh 40,000. Sorry, 2 lakh 40,000. Next would be capital reserve. Is there a capital reserve balance? No. So then securities premium 2 lakh 75,000. Securities premium account debit 2 lakh 75. Then we have general reserve. General reserve is 1 lakh 60,000. Then profit and loss account. 10 lakh was the requirement. 2 lakh 40 plus 2 lakh 75, 1 lakh 60. 675 is already taken. Balance from profit and loss account 3 lakh 25,000. To bonus to shareholders account. Total is 10 lakh. Being reserves utilized towards bonus issue. So what will be the next entry? Bonus to shareholders account debit. This will also happen on the same date. To equity share capital account. How much? 10 lakh and 10 lakh. Being bonus shares issued in the ratio of 1 share for every 4 shares held. Clear with this? Yes. So this completes our bonus issue. Now let's roughly observe the impact. Total number of shares was 5 lakh, that is authorized capital. 4 lakh is the equity shares. From bonus issue, 1 more lakh came in. So 5 lakh is already taken care now. I hope this point is being clearly observed by all of you. Reading further. On 1st June, the company should write shares at the rate of 2 shares for every 5 shares held on that date. On that date is what is important. So on that date means it also considers the bonus impact. Existing shares was 4 lakh. 1 lakh was added further from bonus shares. So total existing shares is 5 lakh. So bonus right ratio is 2 shares for every 5 shares. Number of right shares will be 4 lakh shares plus 1 lakh from bonus issue into 2 for every 5 held. That is what is given, right? 2 for every 5 shares held. So this will be 5 lakh into 2 by 5. Number of right shares is 2 lakh. So what is the right issue price? It has been issued at 12 per share. So what is the entry on 1st June company issued right shares? All the right shares were accepted by the existing shareholders and the money was duly received by 20th June. So the entry happens on 20th June. Bank account debit to equity share capital account debit to securities premium account. 2 lakh is the equity shares issued at 12 rupees. Yes, 12 rupees into 12, 24 lakh. 2 lakh into 10 will be 20 lakh. And then 2 lakh into 2, 4 lakh. Being right shares issued at rupees 12 per share. I hope this is understood. Now what happens is equity share capital is further getting raised by 2 lakh shares. If you observe, in authorized capital 5 lakh was already considered. So again the capital clause need to be altered. So here we will bring a note. You can just write down here. This is after the journal format. Since I've drawn it here, I'm just putting it here. Since the balance of authorized capital need to be increased after right issue, a resolution is required to be passed in general meeting by the company. So this is a note which you should mention. This was a good practice question combining both bonus and right issue. I hope all the concepts along with questions, whatever we discussed, is easily understood by all of you guys. If you just observe, the unit is very simpler. You have to just observe and remember few tricky points. That's it. And be very careful while applying the ratio calculation. Apart from that, there is nothing more complicated in this unit. So it is really easy to score. Practice it well. Make sure you're not skipping this topic. Until I bring out the next video, keep giving the best effort, guys. All the very best. Take care.